Okay, what we're going to talk about today is to discuss where are interest rates headed. Had lots of questions from clients about this issue, just wondering what they should do, how they should position their portfolio. And there's been a lot of chatter in the financial media about where interest rates are headed. Right now, most people are assuming that the Federal Reserve is going to raise interest rates in June. So people are really worried that interest rates are going to start climbing up again. And of course, being the contrarian that I am, I'm actually taking the opposite view of what everybody else is thinking. Before we get into that, I just kind of want to talk real quick about 2014, the asset class returns. It was really another year of diversification. So it's one of those years where diversification actually hurt the investor and didn't help it. Had you been invested strictly in US stocks, just like in 2013, that would have been the best place to be. So by adding other asset classes to your portfolio, you actually had a drag on your overall return. But again, most people know that, hey, diversification it's a process. It's something that works over time. You're not going to get the best return every year. When you diversify portfolios, you're going to have asset classes that go up. You're going to have asset classes that go down. That's just how it works. But just to give you an idea of what 2014 looked like, the best performing asset class for the most part was real estate investment trust. So REITs had a great year, up about 18%, depending on what kind of real estate investment trust it was, but it was up about 18%. The S&P 500, which is the most common metric, most common benchmark for the US stock market, was up just under 13.7%. US bond market was up just shy of 6%. Small company stocks in the US, although they spent most of the year in the red, they end up eking out a 4.89% return last year. But then you have other asset classes that didn't do so well. Emerging market stocks, they were down about 1.8% last year. And they were kind of buoyed by the performance of China. They would have been down even more than that had it not been for China. Developed international markets in Europe and the Pacific, which is often measured by the EFA, which stands for Europe, Asia, and the Far East. Europe, Australia, and the Far East. That was actually down almost 5% last year. And then gold had a negative return of about 3%. And then commodities overall, if you look at the whole spectrum of the commodity market, was down about 16%. And oil, which is probably the one that most people focus on, was down about 50%. So it was good when you go to the gas pump, but if you were investing in commodities, it wasn't a very good thing. So again, we're going to talk a little bit about where interest rates are headed. And right now, my portfolios, I have a lot of vehicles that are interest rate sensitive. I have a lot of longer dated bonds. I've got TLT, which is the iShare 20-year Treasury. I've got BND, which is Vanguard Total Bond Market, more of intermediate bonds. Those are two big holdings I have right now. Rather than going on the short term, I've extended out to longer term. I also have a lot of real estate investment trusts. I've even added mortgage REITs last year. So mortgage REITs are extremely sensitive to interest rates. If interest rates go up, mortgage REITs get hit pretty hard. Mortgage REITs add leverage. That's how they get some nice returns. Right now it's yielding over 10%, but they do that by adding leverage. So if you take something that's interest rate sensitive and you add leverage, any move up in interest rates is going to have a big impact on that investment. But I do like mortgage REITs right now. They basically make money on the spread between what they could borrow at and what they loan at. I also invest quite a bit in master limited partnerships right now. Now, they've gotten hit a little bit as oil has gotten hit. But ultimately, I think MLPs are more tied to interest rates than they are to the price of oil. So I do like them. They're yielding close to 6% right now. But again, they are interest rate sensitive. So that 6% doesn't help you if the investment loses 10, 15, 20%. So why do I think interest rates are going to stay kind of where they're at? Well, the first reason is looking at longer term historical information. So I think we're in a period where we're going to have several years where rates are going to stay pretty flat. Now, they may go up 1 or 2%. They may come back down 1 or 2%. But from point A to point B, I think we're going to see a pretty flat interest rate environment. Why do I say that? Well, there's a couple other eras where we had a banking crisis, a debt-induced banking crisis. In the US, 1873, and of course the Great Depression, which started in 1929. But we also have Japan in 1989, which also suffered the same bout of a debt-induced economic panic. With Japan and the US in 1873 and 1929, what you saw was interest rates came down considerably after the event, and they stayed there for the better part of 20 years. Japan, people have been calling for rates to rise in Japan really since the early 90s, but yet for the past 25 years, rates have stayed almost exactly where they are. In fact, they've actually dropped in Japan. Their 10-year now is under 1%, and it's been that way for a long time. A lot of people have lost a lot of money betting against Japanese government bonds, the 10-year over there. It's been called the widowmaker trade for the past decade because people have been betting against it, and they've been wrong in almost every instance. So if you look at history, history would say that we're probably in for a long period of low interest rates. The US most recent debt-induced banking crisis was in 2008. So we're really just over 6 years in, and not even quite that long into this. So if we're looking at a typical 20-year period, we could have easily another decade where rates kind of stay where they're at, just based on history. But even if you ignore the longer term history, I think there's some shorter term history that basically lets us know that rates are going to stay sort of where they're at. They may even come down. And this goes back to what happened in 2013. So in 2013, we saw interest rates climb 115% from July 2012 until July 2013. Now, that may not seem like a lot when we went from, basically 2% to 3.5%. That's not bad because 3.5% rate is still a pretty good rate. But, the 150% move is a big move in interest rates over such a short period. In fact, it's only happened 16 other times in our nation's history. And in all of those other previous cycles, interest rates after the initial ascent declined. They went down. And in fact, what happened was we saw that from the peak to the next trough, interest rates declined on average about 35% in those 16 periods. The other thing that's interesting to note is it usually took between 300 days to 700 days for most of those declines to happen in interest rates. So we're talking here at least a year, more like 2 years it takes for the actual drawdown to happen. So that spike that we had in January 2013 more than likely is going to see maybe a year or two where things come back about a third. And we've already seen rates come back down from their peak in 2013. The 10 years back now, just around 2%, just under 2%, whereas before it was at 3%. So we've already seen about a 30% decline in rates. So we could see things come down a little bit further, but what I think will happen is we'll probably see things sort of steady out here. Again, we'll have fluctuations up and down, maybe 1% or so, but longer term trend, again, from point A to point B, looking at 10, 20 years, I think we're going to see a pretty flat interest rate environment. The other reason I think that interest rates in the US are probably going to stay kind of where they're at is going back to we're the least dirty shirt in the hamper. So, the funny thing is, it's not that we're in a good situation. We have a lot of debt as a nation. Our government has a lot of debt. Our corporations and individuals have a lot of debt relative to the gross domestic product. But we're better than what many of the other countries are. If you start to look at the yield on 10-year government bonds in other countries, and you look at their debt to GDP, you'll start to see that even at our low rates right now of about 2%, the United States looks pretty good. For instance, France is looking at about 0.6% on their 10-year treasury or their 10-year government bond. Italy's at 1.6. Japan's at 0.4. UK's at 1.8. Ireland's at 1.12, Spain's at 1.5%, Portugal 2.3, and Poland's at 2.3. So essentially, when you get right now at 2.14% for the US 10-year, you take your money, you put it into a US 10-year treasury, you're going to get just over 2%. If you invest in some of these other countries that I just mentioned, you're looking at anything from 0.4% to at most 2.3. And these are countries, would you invest right now in France or Italy or Japan or the UK or Spain or Ireland compared to the United States? I wouldn't. If you look at the debt to GDP for many of these countries, they rival ours. We're at 100% debt to GDP, but then you look at Italy, which is 133%, Japan's at 228%, the UK's at 91, Ireland's at 123, Portugal's at 129. So many of these countries have worse debt dynamics than we do, but yet they have a lower yield. So I think just in general, the US rates are going to kind of stay where they're at, mainly because we are a much better offering than what you're going to get elsewhere. Finally, the other reason I think rates are going to sort of stay where they're at is I don't think the Fed's going to act. Or if it does act in June, it's probably going to be pulling that interest rate hike shortly thereafter. The big reason is so far this year in 2015, and we're talking less than 2 months, we've had 20 central banks around the world reduce their interest rates. They are cutting. So we would be one of the very few that are actually increasing our rates. The problem is when other central banks are cutting, their currencies losing value relative to the dollar, which means that they can export more product to us, but it means we can't export as much because our goods and services become more expensive. So there's definitely a headwind with the dollar strengthening relative to other currencies. So the Fed probably isn't going to want to exacerbate that situation any further. And an interest rate hike by the Fed would probably do just that. If you look at the US dollar versus the euro or the Japanese yen over the past year, you can see the dollar is getting much stronger relative to those currencies. So a lot of the countries in Europe and then, of course, Japan are happy with that because they can export more goods, but that is very bad for our companies that export. And it's also bad for the big multinationals who do a lot of business in foreign markets, because when they take those sales in foreign markets and can bring it back and convert it to dollars, they're losing money. So it hurts earnings. So I just don't think the Fed is going to get off the gravy train, if you will, and start raising rates in June. I really think the fact that the dollar has strengthened so much is probably going to keep rates down where they're at because the Fed's not going to want to get in there. And also because with the stronger dollar, it should attract money to our bonds. So those are the main reasons I'm kind of staying with vehicles that are interest rate sensitive. I really honestly believe that what we're going to find is interest rates are going to kind of stay where they're at. Again, they'll muddle back and forth a little bit. There's always volatility in markets. But I think people who are calling for big moves in the bond market are really not going to be correct. Now, I could be wrong. This is just an analysis on my part. But I do like the fact that I'm kind of in the contrarian position. Most people think the opposite of what I am. So that does provide a little bit of solace to me. But again, I'm going to watch rates. And if they do start to climb like they are, I'll liquidate my positions in TLT and BND and some of the mortgage REITs, and we'll go to shorter term vehicles. So I hope you found this information helpful. You can sign up for my monthly newsletter at picketfencefinancial.com/education. You can also visit our Facebook page and follow us there, or YouTube. If you go to Kirk Kinder, you'll get all of these webinars as well as our newsletters online. So I hope you found this interesting. If you have any questions, please let me know. Thank you.